Hello, in today's video we're taking a look at the September 24, 2025 trading session for the SPX CBOE index. So today is Wednesday, September 24, 2025, and we will be looking at using the day trading GPS SPX Daily Key Levels indicator, the newest version of the indicator v2.0, to make SPX 0DTE option entries. Okay, so the way that this indicator works is that at 9:30 a.m. Eastern New York time, each trading day the SPX is open. You will get the levels on your chart for the CBOE SPX index. The most important level of the session is the SPX Bull Bear KPL, which stands for key price level. For today's session, it is 66.6928. So what this level means is this is the most important bull bear pivot for today's trading session. So it is bearish below and bullish above. The levels above the BBKPL are your take profit targets for bullish entries that are triggered from the bull bear KPL, otherwise known as the BBKPL. Conversely, the levels below the BBKPL are your take profit levels for entries, for bearish entries triggered from the BBKPL level. The default settings are you have 6 main levels above and 6 main levels below the BBKPL level. This particular indicator, we added 4 additional levels, so you can have up to now 10 levels above and 10 levels below. Those levels can come in very handy on the 3 or 4 days a year that we happen to have extreme high volatility sessions due to news events, world events, etc. Or if we enter a period of extreme volatility that is extended over a period of time, such as we experienced in the pandemic. Okay. So as you can see here, we also have additional levels called YDH, PMH, PML, YDC, and YDL. Those are also shown on this optional table you can display here. This table here is also optional. If you don't want it on your chart, you can simply turn it off, and you can certainly also turn off this table in your user control panel. We have a whole video on all the inputs and features of this indicator, which is a separate video. It's about an hour long. If you're interested in seeing that video as well to see all the features and all the inputs in the user control panel, then you can email us at daytradinggps@gmail.com to request the link to that, and we can send that to you. Okay, so what do these levels represent, these additional levels here? PMH is the SPX pre-market high. PML is the SPX pre-market low. YDH is yesterday's RTH session high. YDL is yesterday's RTH session low. And YDC is yesterday's RTH session close. These levels are also important in the general context of today's session, as they provide additional context and confluence where they are seen with other levels. Such as the case here, where you have yesterday's daily low at 66.4558, coinciding in confluence with the S2 level for today of 66.4577. So price often seeks to test the PMH, PML during the session, and breaking out of that range, it can also test the YDC, YDL, or the YDH levels. So those are also important levels to keep track of during the session, which is why in this version of the indicator they were added. You also have in between the main levels, midpoint levels, as well as QL levels. Midpoint levels are the midpoint between each main level. So for example here, mid BBKPL R1 is the midpoint level between R1 and the BBKPL. The QL levels are quarter levels above and below each main level. So for example here, QL above BBKPL and QL below BBKPL. In the user control panel, you can turn on individual midpoint levels as well as QL levels above and below each main level. The default setting for the indicator when you first use it is that the default settings will show the first midpoint above the BBKPL, the first midpoint below the BBKPL, as well as the first QL above the BBKPL and the QL below the BBKPL. What those are used for are stop losses on bullish and bearish entries triggered from an entry signal coming from the bull-bear key price level, which often happens at the initial part of the session, as was the case today. So for example, on today's session, we have a bearish entry signal on the opening 9:30 a.m. candle, which is this candle here, which is marked off by this line here. We're on a 2-minute time frame. This is the recommended time frame for day trading with this particular indicator. This indicator does work on time frames ranging from 1 minute up to 30 minutes. So if you're the type of trader that likes to use a larger time frame, such as 10 minutes, 15 minutes, or 30 minutes, then this indicator will also work on those time frames as well. But the recommended time frames for intraday trading are generally between 1 minute and 5 minutes, with the most recommended one that we use in all of our videos being the 2-minute chart time frame. What time frame you use is of course up to you, the trader yourself. You may prefer a different time frame, but we're simply pointing out, in our opinion, what is the optimum time frame to use. Okay, so here we have a cross below and a close below the BBKPL. That is your bearish signal if you wish to take an entry off of the bull-bear key price level. This happened on the 9:30 a.m. candle, and so on the close of this candle at 9:32, since this is a 2-minute candle, it closed below the BBKPL. As you can see here, the wick extended above the pre-market high as well as the QL above the BBKPL, but ended up closing below after creating a wick below as well. So that is your bearish signal here. How you trade with this indicator based on this bearish signal, if you wanted to enter this trade, is you have 3 different options as far as what strikes you would, what put option strikes you would use on this bearish entry. The first option would be a put option strike that is closest to the 66.6928 bull-bear KPL price. SPX trades in 5-point increments, so that would be the 66.70 put option, which we have outlined here. So that would be considered the at-the-money put option. You can also consider 2 out-of-the-money put options that are the first 2 levels, the first of those 2 levels being the midpoint level, the second one being the S1 level. So in a bearish entry, either at the money at this level or put strike that is closest to the midpoint level below it. In this case, that is $66.63.40. So the closest put strike to that would be the 66.65 put. Next and finally, we have the S1 level, 66.57.52. The closest put strike to that is 66.60. If this was below 66.57.50, such as say 66.56.70 as an example, then the closest strike would be the 66.65 strike. 66.55 strike. But since it's slightly over the halfway point between those strikes, then you would go up to the one closest, since it's slightly over the halfway point, and that would be, in this case, the 66.60 put. We'll be taking a look at the Thinkorswim option charts to track the prices that we have outlined here, so you can see how the different prices are in the data box windows as time moves on in the session using Thinkorswim. Keep in mind, this indicator is for the TradingView platform only, and that we're simply showing Thinkorswim option charts to validate the prices on these options when they hit different levels. And Thinkorswim is a very popular trading platform that a lot of people use. However, it's not necessary to use that platform. We're simply showing it because they provide nice charts for options that can easily display the data box windows. And their interface for doing that is much better than TradingView's. So you use this indicator for charting on TradingView and do your trading on whatever broker you want, whether it is Thinkorswim or TradeStation or E-Trade or Robinhood or Webull or one of the many others. Okay, so getting back to the midpoint levels and the quarter levels. So since we're looking at an entry triggered from the bull bear KPL and we're looking at a bearish entry, your tight stop loss on a bearish entry triggered from the bull bear key price level is the QL above the BBKPL. So your tight stop loss in a bearish entry triggered by the BBKPL level is the first QL above BBKPL, which in this case for today's session is 66.72.22. Your standard stop loss in a bearish entry triggered from the BBKPL level is the first midpoint level above the BBKPL, which for today's session is 66.75.16. Generally, even though neither one of these came close to being stopped out today, generally it's a better idea to use the standard stop loss levels. However, some people prefer tighter stops, and so if you prefer tighter stops, then you use the QL level. Conversely, if instead of a bearish entry here, price action had instead gone the other way at the open and crossed above and closed above the BBKPL, then in that case our stop loss on an entry trigger from the BBKPL on a bullish entry would be, the tight stop loss would be the QL below the BBKPL, and our standard stop loss would be the first midpoint below the BBKPL, which is mid BBKPL S1. Okay, so going back to the prices here on your three different options that you had for put strikes. On this candle close here, which is the 9:30 a.m. candle closing at 9:32 a.m. The 6670 0DTE option is $11. So if you use that option, one contract will cost you, the price is 11, and the cost of that you multiply times 100, because with options you multiply the price of the option times 100 to get your total debit. So one contract would be $1,100. If instead you choose to use the slightly out of the money put strike closest to the midpoint level, that was 66.6340, and that would be the 66.65 put. The entry price on the close of this candle for that option was $8.60, so that would be $860 per option contract. And finally, the last option that you would have for a bearish entry here off the BBKPL would be using the furthest out of the money strike, which would be based on the S1 level, and that was the 66.60 put strike, and the price on the close of this 9:30 candle for that strike was $7, so your cost would be $700 per option contract. So if you have one option contract in this example, $700. If you had 5, it would be $3,500. And if you had 10, it would be $7,000. Okay, so as you can see here, we had a pretty fierce move down to begin the session. In here at the 9:48 a.m. candle, it hits both S1 and yesterday's daily close. So that's yesterday's daily close. Here's S1. And that happened all in this candle here. On the close of this candle, the 66.70 put is now $19. You paid $11, so that's an $800 profit. The 66.65 put is now $15.70. You paid $860, so that's roughly $710 profit. And finally, the 66.60 put is now $12.90. You paid $7, so that is a $590 profit per contract. In using this indicator, if you're just the type of trader that likes to scalp options and not let the option play out to its fullest extent, then this, when you hit S1, that is your trigger to get out of the trade. And what I mean by that is it's a one level move. So it's one full level from the BBKPL down to S1. A half level move would just be the midpoint. So since our entry is triggered off of the BBKPL, your exit on just a scalp, if that's the kind of trader you are, would be at the S1 level, because that is a one level move. Now keep in mind that as the session rolls on, the way this indicator is designed is that you can take entries and exits off of the other main levels as well. So for example, later on in the session, you could take a trade, for example, off of the S3 level down here, a bullish trade. And if you did that, then your tight stop loss on this trade would be the first QL below S3, and your standard stop loss would be the first midpoint below S3, which would be your mid S3, S4 level. We have other videos that go into more detail about taking trades off of other levels as the session progresses. And I encourage you to watch some of the other videos, which if you look at the next couple of videos that were done earlier this week, we go into more detail on that. And we're not going to be doing that particularly in this particular video today. But just keep in mind that you can take bullish and bearish entries off of the other levels above and below the BBKPL as price action continues to move through them, later on in the session. It's just at the beginning of the session, your initial trade is typically 90 to 95% of the time going to be based off of price action in the first, say, 2 minutes to 15 minutes of the session off of the bull bear key price level, depending on how it opens up and progresses from that point. Also keep in mind, just as another note, that there's no rule that says that you have to take this trade here. So if you're the kind of trader that prefers that you want the session to start playing out, breathing a little bit, and you'd like to see what's going on, and you prefer taking trades later on in the session, like say after the first hour is over with or the first 30 minutes is over with, a lot of traders look at the 10 o'clock time frame or 10:30 time frame as an entry window as well, and other traders look at other windows throughout the session. A lot of other traders do, though, like to trade the opening candle or the opening few minutes of the session. And so if you are doing that, then as we pointed out here, most of the time your trades are going to be taken off of the BBKPL level, because that is typically going to be the level that is most prevalent at the beginning of the session. Okay, so moving on here, as you can see, we got another large candle move down just after this candle. So just the very next candle down at 9:50 a.m. it hits the mid S1, S2 level. At this point, we've moved 1.5 levels from the entry level that the trade was triggered from. So a half move here, 1 level move here, and now 1.5 levels to here. At this point, the 66.70 put is now 23.10, the 66.65 put is now 19.30, and the 66.60 put is now $16.15. The 1.5 level move is a very important one, because at this point, this is your minimum target exit for normal trades if you're not scalping. So if you're scalping would be a 1 level move. If you're just doing a normal trade and not scalping, then a 1.5 level move is your minimum target move for exiting all of your options. Or in the alternative, making an adjustment to your stop loss at this point to see if price will continue down further in your favor, further down, because this is a bearish play. So in this case, if we're looking for a further move down, at this point we would either exit all of our contracts here 100%, or if you prefer to see if you can continue to move down to a full 2 level move, 2.5 level move, a full 3 level move or greater, then this is the point where you would either, if you're not going to close out any of your contracts, then you would adjust your stop loss on your contracts at this time at the 1.5 level move. And you would do, excuse me, you would be doing that by one of two methods. Either A, you would now adjust your stop loss to break even, which you can do by either moving your level down that you're tracking to a level that is right at where the entry is, or the simpler method is to just go ahead and put a stop loss in on your option, a break even, which would be the price that you paid, or to add a little cushion on top of that and make it break even plus a little bit of profit. So for example, here we paid $11 on this entry of the 66.70, and now it's $23.10 when it hits this level here. So if you wanted to stay, if you were not exiting your trades 100% here, and you were doing an adjustment of your stop loss based on price, then as an example, you would want to put your stop loss at least $11, which is what you paid. So that would be the break-even stop loss. Or you add 10 to 15% of $11 to the $11 to then create a profit cushion, so that if price does retrace, that at least you still have a small profit on the day from this trade. So as an example, 10% of 11 is $1.10. 15% would be roughly $1.65 or so, or you could even perhaps even go up to 20%, which would be $2.20. So the general idea is that if you are going to add something onto the break-even price to make sure that you do have some sort of profit on this adjustment of the stop loss, should price retrace and stop you out, that you do so of somewhere between 10 and 20% if you're adding a cushion to it, or at least the break-even price at the bare minimum of an adjustment of $11. And then as price continues to keep moving in your favor, you would keep adjusting the stop loss to a bigger and bigger cushion, locking in more and more profits as it keeps moving in your favor. You just have to keep in mind that you do need to allow it to, especially on the first adjustment, you have to allow enough room for price action to breathe a little bit, because in most times it is going to stair step down, take a breather, retrace a little back up, and then continue in the same direction, or perhaps reversed. But if you make your stop loss too tight, then you will get stopped out too often. If you make it too extreme, such as when it's 23.10, instead of adjusting it to 11 or 12 or 13, you adjusted it to 22 or 21, that is too tight of a stop loss. If you're more inclined that that's what you should do, then you should just go ahead and just close out the trade at 23.10 and not do a stop loss adjustment. If you're the type of trader that likes to scale out of your trades, and what we were discussing before this is if you were adjusting the stop loss on all of the contracts that you had, whether it's 1 or 3 or 5 or what have you. If you're the type of trader that likes to scale out of trades, trade multiple contracts, like say for example you traded 5 contracts, then at this 1.5 level move point, you can also consider just closing out 70 to 90% of the multiple contracts that you have, and then leaving the remaining few contracts as runners, and then adjusting the stop on the runners. So for example, if you had 5 contracts that you bought here for $11 that were the 66.70, when it gets down here to 23.10 after this 1.5 level move, then you would sell 4 of the 5 for 23.10. Then you would leave 1 contract of the 5, and then you would adjust your stop loss on that 1 runner remaining to either break even of $11, or adjusting it to with a cushion of profit above the 11, making it, as an example, somewhere between $12 and $13. And then you would just do the same thing going down on that 1 remaining runner. As price continues to move more in your favor, then you would add more and more of a profit cushion. Okay, so continuing on here, this is 11:46 a.m. here on this candle. So on this candle, it hits both the YDL level and the S2 level. They're very close together. So here on this previous candle, it didn't quite just make it there, but on this candle, it does make it there and breaks through it. So in this candle close, the 66.70 put is now $29.37. Remember, we paid 11, so now we're basically up to $1,800 in profit. The 66.65 put is now $24.60. Remember, we paid $860, so that's roughly $1,600 in profit. And the 66.60 put is now $20.27. We paid $7, so that is roughly $1,300 in profit. Here, 10 minutes later at 11:56 a.m., price on this candle here hits the mid S2, S3 level. The 66.70 put is now $35.10. The 66.65 put is now $30.40. And the 66.60 put is now $25.90. So 15 or 16 minutes later at 12:12 p.m., price hits the S3 level here. Here you can see a touch and a bounce off of it, and then we have a retest here, and then we got a move back up from this level. But on this candle here, where it does actually touch the S3 level, if you were looking for a 3-level move, then you would want to get out at the touch of this level, or you could wait until the candle closes as well, because in some cases it will close below. So on this particular, and the reason we're looking at a touch of that level is because this is a full 3-level move, and when we're in normal volatility, or normal to moderate volatility, usually a 3-level move is about all that you're going to get on most days, and on most often you're more looking at 2-level moves. Okay, so at 12:12 p.m., like we said here, it hits S3. The 66.70 put is now $45.10. Remember, we paid 11, so that's $3,410 profit. The 66.65 put is now $38.76, so that's $3,016 profit per contract. And the 66.60 put that you paid $7 for is now $33.55, so that's $2,655 profit per contract. And as we talked about earlier, if you had skipped all this and you were just simply waiting for an opportunity, then this would be an opportunity here, especially when you see this bounce off of this level like this with this wick, and then another one here for a possible long play. And as I said, we go into this in more detail in other videos, but just real briefly, if you did do that, then you would be looking at either an at-the-money call option of closest to the 66.2225 level, which would be the 66.20 call option, or a first level above, which is 66.3401, so that would be your 66.35 call option, or the one level up above the S2 66.4577, that would be a 66.45 call option. And you could look at all three of those because it's still relatively early in the session. If this had happened later on in the session, then you would probably not want to consider this further out of the money option if, say, this was in the latter part of the session, because you also have to allow enough time for price to move as well. Okay, so another part of the strategy with this indicator and this 0DTE strategy in general is that you have a lotto option window every day that starts at 2 p.m. and lasts until the 4 p.m. These are EST New York times. Lasting from 2 p.m. to 4 p.m. close. If you're considering any lotto option plays, then only use, and this we're talking about SPX 0DTE options, then only use up to 10% of your session profits. So first off, lotto option plays are not mandatory. So what you're trying to do here is you're trying to magnify your winnings by taking a very small amount of your profits that you've accumulated in the session and putting it towards a possible lotto play based on price action later on in the session when option prices become much cheaper as time rolls on towards the 4 p.m. close when they expire. And in doing so, what you're looking to do is only use up to 10% of your session profits for any play you might be considering. So for example, let's say as an example, you traded one contract, you did a good job of managing your trade, and you managed it all the way down for a 3-level move, and you ended up with $3,410 profit on the day for that one put option contract. So during the lotto window, you could take up to $341, which would represent 10% of your profits from the session, to possibly apply towards any lotto option trades. And the lotto option trades would generally be somewhere in the 30-35 cent per contract range, all the way up to about $3 per contract, just depending on what time you may initiate them within the 2 p.m. to 4 p.m. window. Keep in mind the 4 p.m. is the close, so as we've stated here, all lotto option plays typically should be initiated sometime before 3:40 p.m. to 3:45 p.m. So that way you still have a decent enough time for price to make its final move at the end of the day. Lotto option plays can return a lot of times anywhere from 3x up to 20x or more, depending on the price you paid and the type of move we have during the latter part to end of the session. They're called lotto option plays because there is a very good chance that the option will be worthless at the end of the day. Because time is running out, for one reason is because time is running out and the options expire at the 4 p.m. close. So as time rolls on, starting at the 2 p.m. window, there's only 2 hours left in the day, and if you waited all the way to 3:40 to 3:45 p.m. as an example to finally initiate a trade, then you would only have anywhere from 15 to 20 minutes left in the session. So that's typically the time you're going to see prices that are going to be 25 cents, 30 cents, 35 cents, 40 cents, 60 cents, etc. During the final moments of the session. But generally speaking, you're looking for options that would be somewhere between, say, 25 cents and $3. In lotto option plays, typically because we're treating them as lottos, meaning we know there's a very good chance that we can possibly lose all the money that we're losing. That's why we only take up to 10% of our session profits to possibly put towards any lotto option plays we're considering. If you do a lotto option play, you could still use the same stop losses as we have up here. That's completely up to you. So as we talked about before, let's say this was later on in the session, then if you took a, let's say you took a bullish play off of this, and let's say this was happening around 3:30 or 3:40, then instead of where it is happening at 12 to 12:30, then if you did want to use a stop loss on your lotto option, then and it was triggered by this S3 level here, then your tight stop loss is the first QL below S3, and your standard stop loss would be the first midpoint level below S3 on the bullish play triggered from the S3 level. However, on lotto option plays, it's also valid to maybe even not even use a stop loss at all, especially if the options that you're buying are very cheap, because price will a lot of times at the end of the session be all over the place, and if you're really just looking to see like a lotto ticket, if you can get a big winner at the end of the session, then not using a stop loss on a lotto option play. Let's just say, as an example, you bought one for 50 cents, that's $50. You already had, as we talked about, $3,400 profit in the session, so you're not even taking 10%. That's why we say use up to 10%. So that doesn't mean that you need to use 10% if you have 3,000, or even if you just let's say had a $2,000 profit, and your 10% would represent $200, and you see a lotto option play that's 50 cents, which would just be one contract, that would be $50. Then you could just let the $50 ride if you're so inclined to not place a stop loss and to see where price may take it. Okay, so when you do place a lotto option trade, if you do, then what you want to do after that is you want to immediately put in your limit order for exiting the trade, especially later on in the session when there's not much time left. If you place a trade at 340, 345, you need to remember to go ahead and put in that limit order to sell your option, and put it at whatever profit factor you feel would be satisfactory to you. So for example, if you paid 50 cents and you're fine with the, let's say, a triple and to go to $1.50, then put in your order at $1.50. The reason being is that at the end of the day, you can see some spike moves in either direction, where a lotto option may go from say 50 cents to $5 in just a matter of a minute or two, and then drop back down to being worthless. So if you are just trying to manually do that without having an order in and try to hit the max on that, that's going to be very difficult to do. It's not impossible to do, but it makes it very difficult because it may only be at that price for just a few seconds. So it's better to have your order already in. If you're trading multiple lotto option contracts, then you could try staggering your orders. If you wanted to try, let's say we take the 50-cent example again, and you wanted to put some orders to sell in at $1.50, some at $2, some at $2.50, and some at $3 to exit, etc., then you could do that as well instead of just an all or nothing. Okay, so here's the cost and profit breakdown. The minimum profit target was a 1.5 level move from the BBKPL entry to the mid S1, S2 level. So remember, that is 1.5 levels moved down. That's the half, that's the full, that's the 1.5, mid S1, S2. So the minimum profit here that we're showing in this range is what price was at for that option when it did hit the mid S1, S2 level. And then the maximum profit here on this range is when it hits the 3 level move from the BBKPL to S3. So that's 1 full level, 2 full levels, and then finally 3 full levels. So in the 66.70 put, you had $11 entry price, that's $1,100 cost per contract, and then your profit was ranged from $1,210 to $3,410 profit per contract. The 6665 put, the entry price was $860. That's $860 cost per contract. And then the range 1930 to 3876. That's $1,070 to $3,016 profit per contract. On the 6660 put, we had a $7 entry, and then a profit range from $16.15 to not a profit range, the exit range from $16.15 to $33.55. So in the $7 entry, that's $700 cost per contract, and then your profit per contract is anywhere from $915 to $2,655 per contract. Okay, so now we're just going to take a brief look at the Thinkorswim option charts I talked about earlier. Okay, so first we're going to look at the 6670 put. So what we have here is a Thinkorswim chart of the 6670 put option, and this is the 0DTE option for expiring today. These vertical lines are the timestamp lines, which we've also got notated, whether like here, entry candle, and then when it hits different levels. These are the data windows showing price. It's also going to show the open, high, low, and close during that candle. So for example here, the 9:30 a.m. candle, which was your entry candle, on the cross below and close below the BBKPL level. On the 6670 put, the close $11. At 9:48 a.m. when it hit the S1 level, for scalpers out there, then the close was $19. On our 1.5 level move, where it hits S1, S2 at 9:50 a.m., the close is $23.10. Here, where it hits the S2 level in yesterday's daily low, the YDL level, the close is $29.37, so that's at 11:46. 10 minutes later, at 11:56, it hits mid S2, S3. The close on that candle here is $35.10. And then 16 minutes later at 12:12 p.m. candle, which is this candle here, which has a very small body and this long wick, the close $45.10. Next we'll look at the 6665. Here's the 6665 put option, the 9:30 entry candle on the cross and close below the BBKPL, $8.60. Here at 9:48 for scalpers when it hits the S1 level, $15.70. Here's the 9:50 candle where it hits mid S1, S2, $19.30. The 11:46 a.m. candle where it hits S2 and YDL, $24.60. 11:56 when it hits mid S2, S3, $30.40. And finally at 12:12 when it hits the S3 level, $38.76. Now we'll look at the 6660. Okay, here's the 6660 put option. One thing you want to keep in mind is the at-the-money options, like the 6670 was on that particular entry, are going to become in the money the fastest, and so they will garner more profit as price moves more in your favor. However, they do cost more. Remember that 6670 put option was $11, whereas the 6660 is $7. So, and then the Other one, the 66.65, was $8.60. So that's just another thing to keep in mind as far as how much you prefer to outlay for the cost of your option versus the reward of becoming in the money faster. Another thing to keep in mind is that with the slightly out of the money options, you do have less money overall at total at risk. So that's another thing to keep in mind as well. However, in most cases, our preference, at least my personal preference, is to use the at the money option. However, every trader is different. It's up to every trader to decide their own process and their own risk profile, what works best for them. And that's a good time to make another point here, which is when you're using this indicator, whether you're purchasing this particular indicator, or even if you've purchased a different indicator from a different company, or even if you found a free indicator to use, you always want to practice with the indicator for a significant amount of sessions on a practice demo account before trying to use it on a real money live account. So a significant amount of sessions for most people is going to be 25 to 30 sessions, so that's 5 to 6 weeks worth of sessions. For more experienced traders, that amount of sessions can be less, but the point of the whole process of using it on a demo account before you use it on a live account is you want to get used to the whole process of using the indicator, get used to the trade entries, stop loss levels, managing your trade, and your profit target exits, and also which strikes that you prefer to use, as well as your entry time frame windows, whether you're the type of trader who wants to trade at the open, or are you the type of trader that wants to let the market breathe and you prefer trading, say, after 10 or 10:30 and then taking your trades off of other levels besides the BBKPL. So those all things that you would find out in a substantial practice period, which again for most people would be 25 to 30 sessions, and more experienced traders would be less than that, just depending on their experience level. But then, at that point, you can go back, you can look through your journal of trades and your process, and you can see where you're at as far as using the indicator, as far as if it's becoming second hand to you. And then when you feel comfortable that you are making a significant amount of profits in your demo account and feel comfortable with using the indicator in the process of using it, then at that time only consider moving over to a real money live account. Okay, so we'll just run through this then. So here at the 9:30 entry candle for the 66.60 put, the price was 7. Here at the scalp at the S1 level, for scalpers out there, it was $12.90. Here at the 9:50 a.m. candle, when it hits mid S1, S2, it's $16.15. Here, when it hits the S2 level in yesterday's RTH daily low, $20.27. Here, when it hits mid S2, S3 level at 11:56, it's $25.90. And finally, here at 12:12 p.m., when it hits the S3 level, $33.55. Okay, so if you do have an interest in purchasing this indicator, we have a link in the description that you would go to purchase the indicator. And you can, in return for taking your valuable time in watching this video today, you can email us at daytradinggps@gmail.com to request a discount promo code to use on your purchase. So if you just email us at daytradinggps@gmail.com, we will and request the promo code. We'll send you a promo code for a substantial discount off of your purchase. So again, we hope you like this video, and please hit the like button and the subscribe button, as it helps us out with YouTube's algorithm. And we appreciate your time today and wish you much prosperity in all your future trading. Thank you.